everyone, welcome to TOI's budget special edition of TOI Wallet Talks. Today we have with us Akhil Chandna. He's tax partner at Grant Thornton Bharat, and he's going to take us through the top 5 personal tax provisions that have come in this budget and the implications for you. Hi Akhil.
Hi, how are you?
Hi. Good. Sir, so my first question to you is that, if I want to assess what the new income tax slabs mean for me, 3 things there. 1, my assessment, which works for me. What are the things that I should consider? 2, from a long-term investment perspective, what do these announcements mean? And 3, in case I have already made some long-term investments, then what is the road ahead for me?
Who doesn't have investments into long-term instruments in insurance policies or Mediclaim insurance or the instruments which are eligible for deduction under ATC or ATD for that matter. I think the new regime holds good for them because there are rationalization from 6 slabs to 5 slabs,
right,
which has resulted into a good saving. To give you a perspective, if a person has an income of 9 lakhs, there is a benefit of 45,000 in tax because of this rationalization which is coming, provided they don't have any investment into these long-term instruments and they are not eligible for the deductions.
Right.
And there for the people HNIs, if they don't have, similarly for them, if they don't have investments in these kinds of instruments, or they don't have any saving from salaried individuals who get deductions under HRA, LTA, those kind of things, then again it's very beneficial for them because the surcharge rate has come down from 37% to 25%. And if you ask me in terms of number, there's a saving of more than 220,000 which is coming to them. So for them, they need to analyze and then consciously take a call whether they want to come under the new regime or the old regime.
Okay, fair enough. And what about for long-term investments, if I have made any, whether it is for my housing loan or anything else?
The government has motivated people to put money into these kind of investments because India as a country does not provide any social security, after retirement. So they have been given a lot of benefits at the time of contribution. Under the new regime, those benefits are not available. Under the old regime, you get a benefit of, whatever interest you're paying on the loan you've taken to buy the house property, or there's a loss of 2 lakhs which will get set off under the old regime. However, in the new regime, that benefit is not available. But whether you still want to do it, even if the benefit is not available, depends on your risk appetite and the kind of returns you're getting, because it's not about just getting the benefit under tax at the time of contribution or making investments, but getting the returns after a certain number of years. That also needs to be looked into and planning has to be done. But as of now, if you ask me, there is no benefit which is available under the new regime if you do investment in instruments like NPS, house property, PPF, medical insurance and all. But interestingly, this year they brought in standard deduction, which was not provided till last year. Maybe depending upon how they look into next year, they might come out with these investments as a deduction. They will allow ATC as well under the new regime.
So you're saying basically there's a wait and watch approach. The new income tax regime is also evolving.
Yeah, I can say that. But the clear indication is that government wants to go away with, old tax regime and go away with the kind of benefits and different, instruments and exemptions available under HRA, LT and all, and want to make it very clear that new regime is the future. And that's how they made it default as a default tax regime for this year. And interestingly, if you, at the time of investment declarations to the employer, if you don't opt, for the old tax regime, your default tax regime is new tax regime. So we have to be very cautious when we are doing this.
And what if I have made some long-term investments, with whatever old tax regime that was available with me? And also, if I'm planning to make long-term investments, then what should I be thinking of?
Let's understand, investment is only not to get the benefit at the time of contribution, but depending on the risk appetite, investment is long-term.
Right.
And I'll give you a perspective. If you are investing in house property, obviously under the old regime, you are getting a benefit of loss under the house property, but under the new regime, you don't get that. Still, people want to invest because there's an appreciation in the property value, and that will give you a benefit in the future. Other than PPF and PF, because they are exempt, I think there's no need to liquidate on that, because at the time of withdrawal also it's exempt. But for other instrument, I think it's a mix and match view, and let's see how the things gonna shape.
Okay. And as an extension to that, if I were to get a new job offer and I have room to negotiate my salary, then what should be the the strategy in terms of reimbursements and all, because the government is clearly looking to do away with exemptions.
As you said, if a person is getting into that negotiation, obviously the employee must be aware of the new structure.
Right.
See what all holds good for them, because there are HR exemptions, there are certain exemptions like long LTA, there are exemptions on if you give mobile handset to the people, there's a tax exemption, there's a books and periodicals, professional development. There are a lot of components which are there. If they become a part of their salary, you get a lot of exemptions, but that's only available under old tax regime. So whenever you're getting into a negotiation, you need to look into that and then take a conscious call which is more beneficial for you, and then opt for that regime.
Okay, fair enough. My next question to you is on insurance policies. The budget announcements around insurance. What is the takeaway for an average policy taker?
I think you've seen in Finance Act 2021, the government introduced certain changes in tax benefit associated with ULIPs, units linked insurance policy. This year they've come out a change in an instruments or life insurance policy other than ULIPs. So the government intent is always to give the tax benefit to small and genuine, cases of life insurance. Because we have seen the people or HNIs, they put a lot of money into the insurance as a part of the premium, because today they contribute, they get some benefit. Tomorrow, when they have maturity of that amount, they will have a huge benefit. Obviously, depends upon, in case of death, anyways, it's tax exempt in all the cases.
Right.
However, if the person survives and get that maturity, they have a huge benefit. To control that, the government has come out with a change that, if you are taking insurance policy, which is issued after 31st of March, where the premium is more than 5 lakhs and is other than ULIPs, then you will not get a benefit at the time of maturity, which shows clear intent that they want to give this benefit only to small and genuine cases of life insurance.
Okay, fair enough. And coming to senior citizens, the limits on the senior citizens saving schemes and the monthly income account have been hiked. So does it make senior citizens to now put more money there?
Obviously, it's a very good move, I can say, because they've enhanced the limit from 15 lakh to 30 lakh, which is almost double.
Right.
And the interest rate which is announced in this quarter is 8%, which is far more than what a normal fixed deposit or saving account or any other institutions give. So right. I think this is a good move and gives a lot of liquidity in the hands of senior citizens.
Okay. My one final question to you is on sending money abroad, or even investing abroad or gifting abroad. What are the new tax provisions like there?
So, before coming to the new tax provision, let's understand what was the provision brought in 2020 budget.
Right.
So there was a TCS of 5%, which was introduced on the transaction like remittance of more than 7 lakhs under the LRS scheme, liberalized remittance scheme.
Right.
Or on purchase of overseas tour package. However, this limit has been increased to 20% under both these categories now. So people has to be very cautious, and they've done. See, there are two things. One is a remittance you're making to your relatives under the LRS scheme for medical treatment or education or whatever it is. So there used to be a limit of 7 lakhs, which is taken away, and 20% is a new rate which has brought in. So 20% will be deducted as a TCS. Second is on overseas tour package, there was no limit earlier, and 5% used to deduct, but now with no limit, continue with the no limit, 20% will be a TCS. So it's a huge impact, and people has to be cautious about whenever they are doing these kind of transactions, because this TCS will be deducted, and obviously it will be credited and taken as a credit against the total tax liability in India. But you need to wait for a year to end and file the tax returns, and then this money will come back to you.
Right. Thank you, Akhil. Thank you so much. I hope your precise analysis has helped our viewers decode the budget personal tax announcements very well. Thank you.